A bombshell has been dropped on the housing market. Foreclosures. Foreclosures are basically when people can't afford their mortgages anymore, so the bank takes back the house. And guess what? They're on the rise in the US. This is especially tough on low-income homeowners. They're getting squeezed by all sides. Everyday bills, other debts, and now their mortgage payments are getting harder to swing. A lot of folks don't realize how crazy expensive it's gotten to buy a house. The average American is spending almost half their income on their mortgage and other debts. That's even worse than what happened back in 2008, the last big housing crash. What adds to the complexity is that with home prices soaring and many people unable to afford them, there's very little margin for error. Even a minor rise in mortgage defaults and foreclosures could spell disaster. According to a report from ATTOM Data Solutions, a major player in monitoring mortgage defaults and foreclosures, while foreclosures did increase in 2023, they remain relatively low compared to pre-pandemic levels, accounting for only 0.26% of all housing units. Although this figure is still low, if we reflect on the period of the 2008-2009 crash, the foreclosure rate climbed from 1.8% to 2.2% of all housing units, marking a modest increase of just 0.4%. However, it's crucial to recognize that even this slight uptick in foreclosure rates had significant consequences during that time. National home prices plummeted by 25%, and certain cities like Las Vegas saw staggering increases in foreclosures of up to 65%. This underscores the significant impact even a slight rise in foreclosure rates can wield on the housing sector. Many individuals may not grasp this reality, emphasizing the importance of raising awareness and comprehending historical patterns. What often goes unnoticed is that during the previous economic downturn, it only took a minuscule portion of homes being foreclosed, roughly 1 out of 50, to trigger a substantial drop in prices. So, the bottom line is clear: the housing market is more delicate than commonly perceived. Even a minor increase in mortgage defaults and foreclosures could spell significant trouble for all parties involved. The housing market's struggle boils down to two fundamental factors: the demand for homes and the available inventory. While we've discussed how foreclosures are likely to flood in the market with more homes for sale, there's another aspect to consider. On the flip side, there's a notable decrease in the number of individuals actively seeking to purchase homes. Mortgage applications for home purchases have hit a 3-decade low. The current mortgage application index is on a downward trajectory, reaching one of its lowest points on record. Such low demand hasn't been witnessed since the mid-90s. Furthermore, investor interest in the housing market has also taken a sharp downturn. According to Dana from Redden Reports, the number of homes bought by investors in the fourth quarter of 2023 plummeted to its lowest level since 2016. Remember the surge in investor activity during the pandemic? Well, that bubble has burst, with investors acquiring only 46,518 homes. Google searches for homes for sale have hit their lowest point in the past 5 years. The search index for homes for sale on Google has decreased from 67 last year to just 52 recently, indicating a significant 23% decline within a year. Moreover, if we harken back to the pandemic period, we're looking at a staggering 45% decrease. Clearly, potential buyers aren't exactly queuing up. The prolonged period of low demand raises concerns about the potential for homeowners to default on their mortgages or face foreclosure. Already, we're witnessing an uptick in defaults across various sectors, including credit cards and auto loans. The critical question looming is whether distress among existing homeowners and on the supply side will manifest before buyers begin to return to the market. It leaves us pondering how many other homeowners might be silently struggling at this moment, flying under the radar. Recall our earlier discussion about banks seizing vacant homes from low-income homeowners? Well, turns out it's not just 1 or 2 houses or homeowners that have fallen prey to this. Day after day, more homes are joining the catalogue of what we call shadow inventory, sitting empty. There have been more and more of these ghost houses across America lately. Something's definitely up, and sure enough, in this case, the house was in foreclosure. There's often a lag between homeowners hitting hard times and their properties hitting the market. So, anyone thinking everything's peachy, that there won't be any mortgage defaults or housing crashes, they're living in a fantasy world. Sure, The government stepped in during the pandemic, banning foreclosures and doling out trillions, which bought some time. But that doesn't mean the underlying issues just disappeared. Households are really feeling the pinch, struggling to make ends meet and afford the basics. This is the crux of the issue with the economy right now. Americans just can't afford it. So, once again, the White House has actually stepped in. They just rolled out some new plans to help people become homeowners and tackle housing issues across the country. The Homeowner Assistance Fund from the American Rescue Plan has helped close to 400,000 homeowners who were in danger of foreclosure as of the second quarter of 2023. The states, territories, and tribal recipients of HF have spent more than $5.5 billion to help homeowners, marking a 32% increase from the first quarter of 2023. They're actually putting serious money into programs like the Neighborhood Homes Tax Credit and down payment assistance to make buying a home more doable. Plus, they're sharing data showing how they're backing low and middle-income buyers, veterans, and first-timers. On top of that, they're making it easier to get financing for home fixes, expanding who can qualify for housing programs, and aiding homeowners facing foreclosure. But it's not enough. It's crucial for Congress to take decisive action and address the housing crisis comprehensively. Why? Well, one significant obstacle hindering the effectiveness of these new programs and initiatives is the alarmingly low savings rate. Currently, savings rates have plummeted to record lows, with individuals setting aside only about 3.8% of their income each month, which is half of the long-term average. Amidst the pandemic, costs across the board surged, inflation spiked, along with property taxes, homeowners insurance, rent, and grocery bills, while wages struggled to keep up. Although there was a period when people received extra cash from government assistance, those resources have since dried up. The consequence? Increased defaults. Mortgage defaults are on the rise, credit card defaults have reached their highest levels in years, and individuals are defaulting on auto loans at an alarming rate. Financial strain is becoming increasingly prevalent among US consumers, underscoring the urgent need for congressional intervention. Let's take a look back at the last economic downturn. In the early stages of 2007, Miami's foreclosure rate was less than 1%. However, within a remarkably short span of time, it soared to over 10%. While it's improbable for any city in the United States to witness such a drastic spike in foreclosure rates again, even a more modest increase to 3% or 4% could have far-reaching implications for numerous housing markets. We're not suggesting that we'll see a universal surge to 10% foreclosure rates across the board, but even minor fluctuations could signal trouble ahead. It's imperative for buyers to remain vigilant and factor in this risk when making decisions about real estate investments. Some argue that with exceptionally low mortgage rates, some as low as under 3% for around 23% of mortgage holders, defaults are unlikely to occur. Indeed, having such enticingly low rates provides a strong incentive to stay current on payments. However, it's important to recognize that the housing market is precariously balanced at the moment. Even a slight uptick in foreclosures could potentially trigger a significant crisis. To put things into perspective, back in 2010, the foreclosure rate surpassed 2%, whereas currently it's at just 0.2%. So, where are we headed? Somewhere in between seems plausible, and therein lies the challenge. With prices soaring and buyer demand dwindling, there's little room for a middle ground. Could this be another impending foreclosure or default waiting to unfold? As we conclude, it's evident that the housing market is grappling with significant challenges. With foreclosures on the rise and buyer demand reaching unprecedented lows, it's imperative to stay informed and vigilant. How do you anticipate a potential uptick in foreclosures might impact the housing market in your locality? Have you observed any signs of distress in your neighborhood recently?